The entity selection you make when you first start your real estate business can have a tremendous impact on the taxes you pay this year, next year, and every year you sell real estate. Today I'm going to show you how to save thousands of dollars. In fact, I'm going to give you an example to save $3,750 this year on your income tax return. I'm Jim Flauaus, realestatetexcoach.com. I empower realtors around their finances so that they pay less taxes, make more money, and have more cash in the bank. So that said, most people start off with the wrong entity selection. Do you know what your entity structure is? How are you set up? Are you a sole proprietor? Are you a partnership? Are you an LLC or a corporation? Well, 85% of agents are sole proprietors. They are sole proprietors by default, meaning they did not go down to the state corporation commission in their state or contact the commission online and do something formal about their entity structure. And so by default, they're a sole proprietor, or they're a partnership if you're a team and you operate with someone else in partnership. But again, you've not set up a more formal structure. The more formal structures would be limited liability company, which is a rather recent event when it comes to entity structures. Limited liability companies today are the most popular selection, and yet they've only been around for about 35 years. They started out in the West, the wild, wild West of Wyoming, but have become very popular. And then corporations, which have been around for hundreds of years. In fact, our country was founded by an English corporation. So let's take a little closer look at this. If you're a sole proprietor, how are you going to be taxed when you file your return? Well, you're going to take your income and you're going to put it on what's called Schedule C. It's a schedule on your Form 1040 tax return. So there's no special return to file, nothing needed extra there. You just have an extra schedule on your Form 1040 return, the same one you've always filed. And that Schedule C will have your income and your expenses. And then you'll pay two taxes on that. You'll pay your federal and state income tax if you're in a state with tax. And let's just take an example, and let's say that your net income is $50,000. That would put you in a 12% federal tax bracket. And then you'd also be subject to another tax, something called self-employment tax. You know, no one ever took out Social Security or Medicare from the checks that you earned when you made commissions on your real estate sales. And so now the IRS is looking for that money, and they're going to collect it on your tax return filing. So that's an additional 15%. You can do the math. What's 15% of $50,000? It's not insignificant. So let's look at the numbers. If you've got a gross income, let's say your 1099 is actually $75,000. That's your gross commission income. It's what your broker's going to report to the government when they file your 1099. And then from that, you can subtract your expenses. Now, I find in working with most full-time agents, they average about $2,000 a month in terms of their real estate expenses. That may sound a little high to you, but if you think about it, how much are you spending on your auto and your advertising and your dues and memberships with the local MLS or your Realtors Association, not to mention your office expense and other costs of doing business, telephone, internet, so on. So let's just say $25,000 is the annual expenses for an agent who's working full-time, and so what your net or bottom line is about $50,000. That's where I came up with the $50,000 example. And the tax, which I explained earlier, is going to be about $16,000, which is a lot of money when you consider that your net income is $50,000 and $16,000 of that is going for taxes. Well, that's 32%. That's a lot. So what do you do to reduce that? Well, you could do a couple of things. You could be a single member LLC. Before I get into this screen, let me just explain that a single member LLC files their taxes the same way that a sole proprietor does. As far as the IRS is concerned, even though you are a separate legal entity in terms of being a separate legal person, you're a disregarded entity when it comes to taxes. The IRS considers you a sole proprietor, even though you have formally taken the step to be an LLC. So you're going to file the Schedule C return, and you're going to have the same taxes as the sole proprietor example that I just went through. You'll pay self-employment tax and income tax. But there's one special nuance that many real estate agents and small business owners are not aware of, and that is that an LLC can choose how they want to be taxed. The IRS never set up a tax form for limited liability companies. Back when they came out in the late 80s, the IRS said, well, we're not going to make another tax form. You just pick what tax form you want to file out of the existing forms we already have. And at that time, they had partnership returns, corporate returns, and of course, sole proprietor returns filed on Schedule C. So the LLC, if it's a single owner, can choose to file as an LLC or a corporation. And as you file it as an LLC, you'll use Schedule C, pay that self-employment tax. But if you elect to file as an S Corp, as your tax classification, then you can really do something creative in terms of reducing your taxes, specifically the self-employment tax. Example, let's say you had that $50,000 net income that I went through earlier. You are separate now as an employee from your business entity, right? The business entity pays you now as an employee. You're no longer self-employed, so do you pay self-employment tax? No. You're an employee of the LLC, which is filing its taxes as an S Corp. And so in that, you will have to pay yourself a salary. The IRS has a rule called reasonable compensation. And the rules on reasonable compensation are if you file as an S Corp and you're a greater than 2% shareholder, which if you're the only owner, that's what you are, then you have to pay the employee shareholder, you, a reasonable salary. Now, why is that rule in place? Well, if there was no rule on reasonable compensation, you'd not have to pay any FICA, Social Security, or Medicare tax, would you? But the IRS knows that many businesses file S Corp returns because they want to avoid overpaying on Medicare and Social Security. So knowing this, the IRS created reasonable compensation rules. And just to give you a short example here, let's say that you pay, that your company pays you as the employee shareholder $25,000 of that $50,000 net profit that was made. So again, your 1099 was $75,000, you had $25,000 in expenses, and then the LLC paid you as an employee another $25,000, leaving the net income now to the entity $25,000. You're going to pay taxes on both the $25,000 of your salary and the $25,000 net income to the business after your salary, but there's one important difference. The money that's paid to you as profit after this salary is no longer subject to self-employment tax. Oh, you'll pay payroll tax on the $25,000 salary. They'll find their way to collect Social Security and Medicare, but you will not have to pay that, and this is a legal avoidance of self-employment tax. It's in the code. It's a legal loophole where in the IRS code, you are an S Corp, you pay yourself a reasonable compensation in terms of the shareholder's salary. The net income to the business after that is not subject to self-employment tax. So what's the amount that's not subject to self-employment tax? $25,000. If you're not paying 15% on $25,000, what is your tax savings? Well, we'll skip right ahead. The tax savings is $3,750 per year. Now, that's this year, that's next year, that's every year you earn $50,000 or more in real estate as your net income. And by the way, if your net income goes up, your tax saving goes up proportionately. Over the next 10 years, that's $37,500 in tax savings because you chose to file your tax return as an S Corp. Now, there are certain questions that still are left over. When do I set up an S Corp? How do I set it up? We're going to address those in another video. But for now, just realize that how you set up your entity selection, what entity you choose, makes a tremendous impact on the cash that you can keep and not send to the IRS when it comes to the end of the year and filing your taxes. Hope you found this information helpful. Please leave comments and questions down below, and also give me a thumbs up if you found this helpful. I'd also like to ask that you subscribe to my YouTube channel. That would be a big help. I'm Jim Flauaus, realestatetaxcoach.com. That's it for this time. Until next time, so long.